Hello there, and a very warm welcome to another video from Change Tips and Tools. It's me again, Phil, the Brummie that hails from Birmingham, England. Now, in today's video we will talk about the project selection process and how an organisation typically thinks about categories and priorities when it comes to investment in change, i.e. builds its book of work or its multi-year portfolio of change through an annual budgeting process. In this video we will look at some useful capital budgeting techniques and then dive into Excel and see how it can calculate things like NPV, IRR and payback information, which can then be used to select the right projects. Now, before we carry on, let's clarify what we mean by a project. So, to quote Prince 2, it is a temporary organisation that is created for the purpose of delivering one or more business products according to a specified business case. Now, typically in any organisation, as part of its annual budgeting process or quarterly reviews, they will need to categorize its change investment under the following funding buckets. So let's discuss in priority of order. Now, your business cannot continue to operate if this type of change is not implemented. Regulatory is where your business will incur fines and reputational damage if this type of change is not implemented in a timely manner. Now, keeping the lights on, these are your maintenance type projects like a HR system update to maintain support contracts or an annual maintenance of the building, for example. And then you have hearts and minds. There is no metric that drives this. It is simply based on the culture and the values of your organisation. We just need to do this, like community initiatives that are important to your investors, for example. And then finally, right at the bottom of the heap, the lowest priority is discretionary. These are your optional projects to create, transform or change something to add value to the organisation, like creating additional business opportunities, for example. Now, discretionary sounds great. However, no organisation has an endless source of funds or resources. So with these constraints in mind, especially considering the first four being prioritised reference budget, how do you select which projects to approve, which can be large investments after all, when considering the constraints in hand? This is where the capital budgeting process comes in. From a change perspective, it is a must know for any PMO or project manager, and the key words are net present value when it comes to return on investment and internal rate of return for how profitable it will be. And then there is the payback period. How long will it take to get the investment back? And also, I'll show you how Excel is a powerful tool and ally that can help with these questions. Have I piqued your interest? Net present value. How much value or return on the investment you will get from a project. So in simple terms, if the NPV is greater than 0, accept the project, or if it's less, then reject it. Now, with NPV, we need to consider the time value of money concept, i.e. we all understand that a sum of money we have now is more valuable than the money you collect later on. That's because you can do more in the present by buying something now and then selling it for more later, or just simply putting it in the bank to earn interest. So hopefully you understand the concept of time value of money, and that $1 or £1 in your hand today is worth more than $1 or £1 in the future. But how exactly do you compare the value of money now with the value of money in the future? This is where the NPV function in Excel makes it really easy. Based on the cash flow and the discount rate, we can calculate a project's NPV easily. Now, I hear you saying or asking about the discount rate. Well, in simple terms, the discount rate will be company specific, as it is related to how the company gets its funds. It's the rate of return that the investors expect on their investment, or the cost of borrowing money. So if shareholders expect a 12% return, that is the discount rate the company will use to calculate NPV. If the firm pays 4% interest on its debt, then it may use that figure as the discount rate. With this in mind, the rate is set by the finance function within your organisation. The internal rate of return is the annual rate of growth that an investment is expected to generate. The IRR is calculated using the same concept as the net present value, except it sets the NPV to be equal to 0, as in the IRR shows the actual discount rate that would set the NPV to 0. The higher the IRR, the more profitability of any potential investments. So, if the IRR is greater than your company's discount rate, accept the project, or if it's less, then reject it. The payback period is exactly as it sounds. How long will it take for the project to pay for itself based on the initial investment? The rules on this are set by the organisation. For example, the investment has to pay for itself within a 5-year period, or it will be rejected. When it comes to discretionary budgets or any type of project prioritisation, I firmly believe that all three pieces of data, the NPV, IRR and payback period, are collectively critical in making the right decisions on which projects should be approved. So, without further ado, I'll show you how to demystify what we change people like to call the black magic of finance. And with the power of Excel at your fingertips, you will see how quickly and easily it can be done. So, let's do this. I have my Excel file here, and I've already put some data in here representing 3 projects. So I have project 1, 2 and 3, and we need to make a decision on which projects we will fund and which projects we won't. So what we can see here is we've got the financial periods, so year 0, 1, 2, 3 and so on. And then we have our cash flows, so we have our costs, so initial cost up front, and then possibly ongoing costs. So for example, if you've created a department, then you will need budget to run that department, for example, or there might be some ongoing service costs that you'll need to pay on an annual basis. And then we have the expected financial benefit here as well. So again, from year 1 here, we've got benefits in here as well. So the first thing that we need to do is that we need to calculate our net cash benefit and our cumulative benefit. So this is how I would do it. Is again, I'm going to highlight these two columns here like so. I'm going to hold down the Alt key and I'm going to press the equals key, and there you go, it's calculated. And again, I'm going to hold highlight, Alt key, equals, Alt key, and press the equals like so. So this is my net benefits, and all that is, this is a negative number as in my costs or my cash flow out, and this is my cash flow in. So these are positive numbers. You add them together, it gives you the net cash benefit. And as far as my cumulative is, first cell will be equals the first net cash benefit. And then from this point onwards, it will be equals the previous value plus my next cash benefit, like so. And then I'm simply just going to copy that down. I'll then copy this for the other two projects. Right, so I've now got my cash flows here. Brilliant. So if you remember, we talked about a discount rate. So let's put a discount rate in here. So let's put discount rate, and I'm just going to put this number, format it there with that style. I'm going to make this cell a percentage, so hit the percentage sign, and I'm going to put 8% as the discount rate. So that's my reference, that's my discount rate for my organisation. The next thing that I want to calculate then, the first thing that we're going to do is the NPV. So NPV, net present value. Let me just put a line like so. So the way that we're going to calculate the net present value is based on the net cash benefit. So this column here. And the way that I'm going to do is I'm going to go equals NPV, open bracket. So the rate, if you remember, is the discount rate. So I'm going to do that, and then I'm going to press F4 because I want to copy this down. So F4 to make it absolute, and then comma, and then I'm going to choose from year one. So the net present value is from year one onwards, not current year 0. So I'm going to take that, drag it down, and then I'm going to close my bracket, and then I'm going to add my initial investment plus the initial investment like so, and press return. So let's do some formatting, and all I'm going to do is I'm going to take this format here, format painter, and then copy it to that cell like so. So that's my NPV for project 1. So let's copy that now, Control copy, and then I'm going to copy it, and it should and there you go. So I've now got my net present value for my project. So if I put this to 0, for example, you can then see it's now valuing the money, the values based on today's value of money. And if you remember, today's money is worth more than money in the future, and the discount rate is used to do that for us. So we can now see the return on our investment. The next thing that we want to look at is our internal rate of return. Our internal rate of return, again, if I put the format as a percentage like so, and I do, let's type IRR, there we go, and again copy that format so it looks the same, and I'm going to do equals IRR, and the value here is I'm going to use the net cash benefit here. So from year 0 all the way to accounting period 5 or year 5. Now the second part of this argument is a guess, so I can guess what I think, you know, the IRR value is going to be, or so it could be 5% or 1.6 and so on, but it's an optional, so I'm going to leave that. And I think, if memory serves me correctly, is that it will automatically set it to 1.6 or 1.5 as the guess. So I'm just going to do close bracket there, then hit return. And there you go, you can see what the internal rate of return on project 1 is. So again, if I copy that, Control copy, I'll copy to my other 2 projects. Now you can see that we're starting to build this picture, and you can see that, you know, project 1 is looking like that is definitely a no-go, as we've got a negative NPV, should I say, and our IRR is below the discount rate. However, our other 2 projects have a positive NPV, and the IRR is higher than our discount rate. In fact, the biggest contender, if we are short on budget, would be project 3 based on this. And the last thing that we're going to calculate is the payback period. Now there's no real function here for a payback period calculation, but I'm going to show you how to build a formula. So we want to find out the payback period, and I'm just going to put that in bracket, so it's years, and again I'm just going to copy that format like so. So what we can see is, if we take the first project, we can see that it breaks even between report period 4 and 5. So it starts to pay back between year 4 and 5. So it's between these 2 values here. So the way that we can find this is using the lookup, not VLOOKUP, using the lookup function. So if I go equals lookup, and my lookup value is going to be 0. So I want to find where it's 0, and then comma. The lookup vector is going to be this column here, and my result vector, or the output, is going to be this column here. Now I should get a 4, hopefully. Yes. So it's found where it hits 0, where we get a 0 is here. So that's the first piece of the puzzle. Now typically what we need to do is take the absolute value here in this current period and divide it by the next net value, or the positive net value, and that will then give us the it will give us our payback period. So first of all, we've got to find this value here. So the way that we would use that, or find that, is I'm going to use this number here. So if I go equals, and I'm going to use the XLOOKUP function, open bracket. So my value would be 4 here. So the lookup value is going to be 4. My lookup array is going to be this column, like so. And my return array is going to be this column in the cum benefit here. So if I take that and then close bracket like so. Wonderful. So it's picked up that value there. The next value that I need to find is this value in the net cash benefit. So again, that will be the same as this. So if I just copy that with some changes. And all I'm going to change here is I'm going to make this look at this column here. So it's going to be column E, like so. So if I change that to E, And then obviously I want to look at the next period after this one, which will be, in this case, will be 5. Bear with me. Great, so I've now got that value there. Now, the calculation, if I do, is going to be equals ABS absolute, so the absolute number, so divided by the next period. So if I add that to that, that would be 4.6 years in the payback period. Great, so that works. Now what we need to do is join it up. So what I'm going to do is I'm going to take this value here, and I'm going to copy it. But what I'm going to do is I'm going to take this and I'm going to copy it. Oops, deleted it by accident. I'm going to copy it, not delete it, copy it. And I'm going to replace this 4 value in the XLOOKUP with that calculation, with that lookup calculation. So Control V. And I hit return. There you go. So I still have the same number there. Great. Next thing I'm going to do is I want to take that there. Again, I'm going to paste it into this value here. I'm going to do Control V, but then I'm going to do plus 1. And I've got the same value. So now we can join all these up. So if I take this, I'm going to do a Control copy and do escape. And I'm going to go this equals plus ABS, because I want the absolute value here. Paste the first one in, divided by, I'm just going to put a 0 there for now, and I'm going to hit return. I've got a div error there, and then I'm going to take this value here, which is finding this, and do Control copy, and I'm going to change that 0, swap it out for that formula, and hit return. And there you go. It's calculating. It's now calculating the payback period. And I'm just going to use this to get rid of some of the decimal points. There we go. And also I'm just going to do an if error. So if there is an error in there, so if error, so if there's an error in this calculation, then I'm just going to put, say, 0. Or no, I'm going to leave it blank. Like so. And return. So that now works. So if I delete that, again, take what I've just created and built there. So it's always great and really helpful if you build your formula in stages like I did there. And if I do Control copy, paste that there, and I'll paste that there, and there you go. So on project 1, we've got a negative NPV, we've got an IRR that's less than our discount rate, and the payback period based on the cum benefit is 4.7 years. As far as project 2, we get an 11,500 return on investment. Our IRR is greater than our discount rate, and the payback is in 3.9 years. But the winner here, even though there's a higher investment here, is that we've got an NPV or return on investment of 314,000 here. We have an IRR that is 13% compared to an 8% discount rate, and it's the project that pays back sooner as well by 3.6 years. So that is the clear winner. So there you have it. Now, this is an easy enough template to create, as you've just seen, and you can see the power of Excel and how easy it makes some really complex financial principles around capital budgeting easy for anybody to do. So I hope you found this video informative and helpful, and you've learned something about the concepts of NPV, IRR and payback, and how you can perform these calculations easily within Excel. And if you did find it useful, I'd be really grateful if you press that like button, click subscribe, and hit the notifications button for future content. And I wish you a wonderful day wherever you are in the world. And please take care, and I look forward to seeing you in the next video. Bye bye now.